So we all need to understand that there are 4 policies for auto liability: revenue, mileage, composite auto, and scheduled. You're too small, you can't do scheduled. But Igor, you're 25 trucks. You should be on a reporter, yes?
I don't know, John. I didn't nibble too much, and since I joined, I didn't do much of the insurance and breakdown. I don't know.
Yep. That's okay, but you understand. So now 6,000 a truck. I'm taking Igor's scenario here now, everybody, right? He's got 25 trucks at 260 per mile, 78,000 miles is the 5 million revenue. Here's the mileage that would drive that revenue. Here's his rates. Everything is pretty equal to $6,000. So at this scenario, it doesn't matter what Igor picks. But if you pick composite auto and he shrunk because the market got bad, he'd be protected. If he picked revenue and mileage and shrunk, he could only shrink 10% and he's screwed, right? Or if we negotiate 80%, then you can shrink 20%. At the same cost per truck, why wouldn't you just do the composite auto? You get it?
Oh, now, John, we have like 15 trucks on the road. Some people are on vacation, some are like just taking break, whatnot. And I know our renewal is coming up soon. Yep. So from what I understood you saying is, okay, report 10 to 15 trucks, and then even if we grow, we started with 15. Even if we get to the number 30, 45 divided by 2 is 22.5.
Yep.
That's if we go biannually.
Yep. Now that's with some markets, Igor, not all of them. There are some composite auto markets that make you report every month. So if you start with 15, then you go to 20, then you go to 22, then you go to 30, you go to 40, you go to 50, you go back down to 40, 30, 20, 15, you're going to pay for those the whole year because it's a monthly composite auto reporter. Now, where would that benefit you? It would benefit you if you started with 30 and ended with 5. Because you don't want to do 30 plus 5 and pay for 17 when you only ran 7 or 8 the whole year. So every one of these reporting policies can kick you in the teeth if you don't predict right. And it has nothing to do with what you did last year. It has everything to do with what you're going to do this year. The way to pay 100% what you use is scheduled. The truck's on the road, you pay. Truck's not on the road, you don't, right? But do you want a scheduled policy with a finance agreement? No. With turnover in trucking, you're going to be adding so much capital and have so much money tied up in loans and interest rates that's going to drive up your rate. If you're going to do a scheduled, you need a direct bill. Composite auto, mileage, and revenue, all of those are direct bill. They're not revenue, you're not paying per truck as you add and delete them on a finance agreement, you see?